welcome everyone. Thank you for joining, and I know this is the last of the panel, but I think our panelists here deserve a little attention. Stablecoins are often described as the low-risk foundation of crypto, but over the past years, we've seen that the yield on stablecoins can come from very different places and sources, and they often bear different risks. Some, leads to disastrous results that we have seen over the past few years. Today, instead of focusing on the headline APYs, we want to unpack two core questions. First, what are the sustainable sources of...
I can't hear you. It's okay, we can try.
It's okay.
That's okay, we'll pay attention.
Okay. Okay, first we're going to talk about what are the sustainable sources of yield across CeFi and DeFi. And secondly, how do we think about risk boundaries? Who bears the risk, and when risk shifts and when it becomes systematic? And to discuss how we build the sustainable future, we're fortunate to have the four leaders joining us today, sharing their perspective from across the stack. So how about we start with each of our guests introducing themselves, talk about yourself a little bit, your project a little bit, and how stablecoin enters your product or protocol.
Certainly. Hello, my name is Mark Richardson. I'm the project lead at Bancor. Bancor is one of the older projects. We're actually slightly older than Ethereum. I think we were the second application built on top of Ethereum after Gnosis, I think. But for those who aren't aware, we invented something called the AMM, which has become something of a pervasive technology across blockchain. It was originally developed for deployment on the Bitcoin colored coin and Mastercoin stack, which never came to fruition. And so after the Bitcoin developer community rejected those proposals, the project then moved to Ethereum. The stablecoin economy, I think, has been a part of the AMM paradigm since the beginning, originally just with things like USDT, but then after that, things like USDC and DAI in particular. And these things continue to be, I think, the preferred numeraire for a lot of cryptocurrencies. And so, yeah, it's a part of the decentralized exchange infrastructure since the beginning, and I think will continue to be.
Yeah, hello. Here is Tim from Spark. I think everyone here is very familiar with the MakerDAO and also Sky. So Sky and MakerDAO to be like a central bank for decentralized the world, and the Spark is like a commercial bank for Sky and the MakerDAO. For example, you can regard Spark as a commercial bank for this system. So we help the Sky and other central bank in DeFi system to distribute the stablecoins, like for USDS, and also you can regard also Spark as Onchain money market fund. So we allocate our stablecoins to other DeFi projects like Morpho and like Evie. So you can regard us like a liquidity provider for every project or every protocols in DeFi and also CeFi in the future. And tomorrow we will have some important announcements in consensus main stage.
Ni hao, wojo samu. I'm still practicing my Mandarin a little bit. Hopefully that didn't sound too bad. But I'm a community spokesperson for the TRON DAO. Been there for about 4 years now. We're an organization dedicated to growing Web3 technology, specifically the TRON network. And in the past couple of years, we've seen a surmountable amount of growth. Very excited to take part in this panel, and thank you to the organizers for allowing us to come and speak. We're very excited to discuss a little bit more about, obviously, DeFi, yield, the risks associated to it. In general, within the TRON network itself, we have about 4 million daily active users, 12 million daily active transactions. We've settled $25 trillion in volume on our network since its inception. So we're very excited to be here, and I'm excited to take part in this panel as well.
Hello, everyone. My name is Gary. I'm a long-term investor in Web2 to Web3. My fund in Web2 is Xinhua and SkySaga Capital. My fund in Web3 is Eureka. And now we are doing the on-chain asset management, which means put many liquid assets on-chain. And that's just pretty DeFi things. And before, actually, we use a CeFi to invest crypto, and this is definitely a wrong way. So we turn to DeFi, and we tokenize all of this liquid asset on chain, which includes QuantFi, LoanFi, and supply chain Fi. And QuantFi actually is a hedge fund as a background underlying asset. It's a yield-bearing asset rebased. And LoanFi is based on different kind of collateral loans and based on the lending protocols. And a supply chain Fi is based on the real trade. It's a supply chain and settlement. It's about real trading. So this is pretty new, and we call this the second growth curve of the crypto. It's no longer the meme version, no longer the narrative version. We will put the real yield asset behind it. And for me, actually, I've got experience for more than 17 years investment, so we're gonna to put all this together on chain. Thank you.
Excellent introductions. And we've actually designed this icebreaker problem before we actually dive into the questions. It's not the core focus of our panel today, but just thought it would be fun to discuss. Like, we hear the term CeDeFi everywhere, like last year and this year, but actually the concept of it is often controversial. Sometimes people say it's like a DeFi with KYC. Sometimes they say it's centralized custody with on-chain transparency. But in your eyes, what exactly is CeDeFi? Like, what's the one feature when you look at this product and make you say, yes, this is CeDeFi?
So I think to say that something is CeDeFi is a little bit oxymoronic in the sense that I consider the centralization and decentralization to be polar opposites of each other. And so to say that something is a hybrid between the two, I think is just acknowledging that maybe decentralization is a bit of a spectrum. But I think what people mean when they refer to CeDeFi is that they would categorize certain financial products as being DeFi-like, meaning that they use blockchains or smart contracts or self-executing code, and that is sort of something that traditionally you would associate exclusively with DeFi, whereas in CeFi it would be something that has a administrative or bureaucratic process that fundamentally moves it. And so to say that something is CeDeFi, it can either mean that there are elements of that bureaucratic process that now oversee the smart contract infrastructure, or that that those elements of like tokenization and blockchain are now being absorbed into those kind of administrative processes. But I think that, you know, the pure definitions of these things are still useful. For me, DeFi will always be something that has no element of human intervention possible inside of it, meaning that there are conditions on the smart contract, and that could include KYC, right? One of the things that people speak about is that, well, DeFi with KYC isn't really DeFi anymore. I reject that, because you can very easily have some, you know, additional infrastructure built into the smart contract that fully encompasses the element of KYC. And that can, you know, I think that's important to recognize, because things like, you know, anti-money laundering and anti-terrorism financing policies should maybe be considered a part of the DeFi stack. And if we can come up with ways to do that that don't require human intervention, then I still consider that decentralized. But I also understand that when those things get injected into traditional DeFi products, people feel like that maybe that is, government or regulator intervention in something that used to be absent, right, from those processes. But to my mind, if there is a smart contract that self-executes, it's DeFi, KYC or not. And if there is a smart contract that requires someone to approve a process manually, then that's centralized, whether or not there's a blockchain involved or not.
Yeah, I think I can say something on top of our business model. I think whether DeFi or CeFi, we should consider all this belongs to the blockchain. For example, previously we only have like a DeFi kind of business model, like people do collaterals like lendings on-chain. But for now, like when I talk with a lot of institutions in Hong Kong and also in Europe, like because a lot of institutions they don't have the ability to do some on-chain lending, so also they were limited by their risk management. This is why they prefer deposit their collateral like a Bitcoin or Ethereum into one of the custodian. This is why just 1 month ago we launched our first CeDeFi business model, which means that all the institutions or wealth they can deposit their collaterals into the custodian like Anchorage, and then we distribute our loan to them. So I think in the future, not separated from DeFi or CeFi, we just see what is the demand of our customers and from the users, and then we just develop our product in the future.
Yeah, I think I liked the earlier response about looking at CeDeFi as it is kind of an oxymoron, but it's good to look at it as a spectrum as well. I like that analogy because, in my opinion, I do see CeDeFi as a way in which gaining access to permissionless markets, but you still need to do proper KYC. It really comes down to the actual asset that you're dealing with as well. For example, there are various assets that are integrated with either the TRON ecosystem or even broader ecosystems like Ethereum, where they have specific assets that are permissionlessly available on more permissionless venues. But in order to actually lend your capital to those specific assets in other manners, you have to go through KYC, AML to ensure that they're meeting regulatory standards in those whatever jurisdictional regions you are. So yeah, I look at it as a spectrum as well in that case, where CeFi is on one side, DeFi is on the other. Obviously, if something is fully permissionless, meaning there is no centralized intermediary that has to be involved in any way, shape, or form, that's full-on DeFi. And then, of course, CeFi is when there is more of that type of involvement. But where the two really intersect, I really think it comes to the point of allocating your capital to those said products effectively, going through the proper KYC, and then the product itself, once you actually have attainable access to it after doing proper KYC and minting it, then you can go do DeFi looping, go do other DeFi venues or wherever else it might be available. So I think that's really where the CeDeFi component kind of comes into play there.
Yeah, CeFi and DeFi actually have got a lot of difference. But first of all, I have to have got a opposite opinion about KYC. And for KYC, actually, because nowadays we have got opinion on KYC, actually it's supervised and given by big banking system. So actually, it's not justice. It's not actually real KYC. Well, I wrote an article 3 years ago. It's about ZK KYC. Once there a protocol can protect your privacy, and then there will be a new kind of DKYC in on-chain. This is very necessary because if there's no KYC, there will be no credit. If there's too many KYCs, there will be overprotection. So there will be a middle point. Will happen maybe 2 years later, but not now. So KYC actually is not the way that, for me, to divide what is the difference between CeFi and DeFi. This is the first thing I want to mention. The second one is how to divide, how to differentiate what is the difference between CeFi and DeFi. Three things. First of all, is the asset, backup asset. Whether you make the strategy asset on-chain. The second one is the settlement, which is the most important. I think the biggest difference between CeDeFi and real DeFi is the settlement thing. CeDeFi actually maybe have some of the DeFi asset, but actually make all of this settlement off-chain. So this is about CeDeFi, and CeFi actually make all of these transactions, settlement, accountings off-chain. So they need a lot. They need a lot of traditional finance things. And if you are CeDeFi, you need many oracles because the settlement work is half off-chain, half on-chain. So this is pretty complicated. We have done a lot of work. I'm the founder of CICADA. We have more than 20 people to do the settlement clearance for both of the CeFi part and the CeDeFi part. It's very complicated because we want to put all of this eventually wrap up into DeFi smart contract. So this is about a settlement and clearance. The third thing actually is the final thing is the liquidity, transaction, and exchange. And this one actually could be easier because we're quite familiar in the last 4 cycles. But the problem is if there's only liquidity, only exchange on-chain, but there's no real settlement and clearance and no real asset behind it, that will be scammer. That will be Ponzi game. So DeFi actually, for itself, on the top layer, it's quite mature because of the last 4 generations. But now why we are doing the RWA things, because this is so difficult for us to do the Oracle, the middle layer about the settlement and clearance, and the bottom layer about the asset and strategies. So we're doing this several years, and I believe that there will be big perspective. Yeah.
Gary, I just want a question. So like, let's say that would you consider permissions or permissionless permissions to still be DeFi? So like one of the very early like KYC approximations was that if you're setting up a liquidity pool, there's an option to provide a whitelist of addresses that are allowed to interact with it, either as a liquidity provider or as just a spot trader. And so if the smart contract infrastructure itself has no ambition, it has no overview or restrictions on what you can include in that whitelist, then would you say that it's centralized for a user to set up their own liquidity pool and say, I only allow my friends to trade with me on this liquidity pool? So I realize this maybe not know your customer, but at least know your trading partner, right? Would you consider that centralized or decentralized?
For this generation, for this stage, I think it will be centralized. But there were several things: AI agent, Oracle, and ZK technology. For these 3 things, we'll develop more for like 1 and 2 years. I think many of these things will be decentralized. Oh, one more thing is a vote strategy and a vote mechanism. So the 4 things plus together, and I think many of the things will be decentralized.
So something needs to be unrestricted in your mind for it to be decentralized? Or can you have restrictions like self-nominated, self-imposed restrictions that would still be classified as
What kind of restrictions you mean? You mean regulations or?
Anything. Could be like, it could be a regulator telling you what the restrictions are, but it could just be the user saying, no, these are my own restrictions, and I just made them up.
Yeah, I understand. To be honest, for this stage, will be a lot of restrictions, and these restriction rules actually are created by us. And it's not very decentralized, to be honest. But we're supposed to push all of this to the vote mechanism and let everyone to come in and join the vote mechanism.
Okay.
Yeah.
Okay, thank you guys. I love the diversity of the opinions, and that actually gave us a great baseline. Now let's talk about where the yield actually comes from and how users assess it. Let's start by looking at the diversity of yield. Sam with USDD 2.0 and the new STRX Vault, you're offering like a dual yield structure that is very attractive for growth-focused users. And Tim's Spark V2 anchors to the Sky savings rate, providing a stable, somewhat predictable option, often backed by RWAs. So we used to think of DeFi users as like all degens, right, as a single group. But the market has matured as we think. But how do you see your respective projects fitting into a user's portfolio today? Do you see a future where users hold both like savings account and growth account? And how do you serve this widening spectrum of users?
You said Sam, correct? Okay, yeah, just want to make sure. Yeah, and the question was mainly on the DeFi users coming into the specific assets, and okay, yeah. So I look at it in multiple ways. No, I don't think it's just open to degen audiences. I definitely think as vaults start to become more matured, either on DeFi lending platforms like Morpho, Aave, etc., and being actually built on those said infrastructure platforms, I genuinely think a lot more institutional players will come into the space. Retail, of course, still has that access to it. It goes into the previous question that we had about CeDeFi and DeFi for CeFi. Can users gain access to permissioned products that you usually have in the US? For example, in the United States, as a retail user, if I wanted to gain or buy a mortgage note and gain access to that, it's very, very difficult to do that as a retail investor. Maybe if the issuer of that asset files a proper S1 classification under securities guidelines, they could do so to accredited investors. But it's very, very difficult to provide that to retail investors. And just because you tokenize something and bring it on chain doesn't mean you completely forget about the classifications and rules of governance that are used to govern those said assets. So I think as the market matures and more infrastructure and technology is being built and the actual assets that are being tokenized are the actual assets, And we're ensuring that everything is being properly structured, whether it be through a special purpose vehicle that's actually issuing receipt tokens that are offering the yield on those assets. I think that's where we can start to see retail investors gaining adequate access to those specific products. And that's where I really think the wave of more institutions will come in. And again, you can walk and chew gum at the same time. I think it would be awesome to have more of that. But I think the biggest barrier right now has to be the user experience, has to be the regulatory arbitrage that needs to be created properly, and of course, making sure everything is done compliantly. There's a reason why in the States so many products are difficult to gain access to. And I think as, again, the market matures, legislation catches up to innovation, we'll be able to see more institutions gaining access to more DeFi-friendly products, and then also vice versa. And I think that's the biggest unlock that I'm very excited to see.
I agree. Yeah, James, do you want to add on that from the Spark's point of view?
Yeah, I think when we're talking about the yield, we should know that the yield is from the revenue of your protocol. So I can just talk about what is the revenue maybe for TRON, also for Spark. Because for Spark, I think 80% of revenue comes from our Spark liquidity layer. So we distribute our liquidity to like Sparkland and also Morpho. This is the first place we earn the yield or earn the revenue compared with others. And also like in the past, I think 6 months, the Spark revenue is much higher than Ethereum layer 1 itself. So you can check on the DeFi Llama. So the second is we also provide the liquidity as a service for stablecoins. For example, like PayPal. Everyone here may know PayPal issued stablecoins in the past few years. So we are the most important distribution channel for PayPal USD, PYUSD. So we are the market maker for PYUSD in the Curve and also Uniswap. So we set up trading pairs between the PYUSD with USDS. So everyone, they want to get the liquidity of the PYUSD. They can borrow from Sparkland and then transfer the PYUSD to USDS and then to the USDC. So which means that the PYUSD, even there are new stable coins in DeFi, they can get the as much as liquidity for USDC if they use the Spark infrastructure. So and also for the CeDeFi yield from we provide our institution loan just a few weeks ago, and also it's a very, very good yield in the bear market. And also for Spark and Sky ourselves, we not only get yield in the bull market, but also in the bear market. For example, in the bull market, the borrowing rate in DeFi space should be much higher. So we distribute more of our liquidity to the DeFi space. But in the bear market, we distribute our liquidity maybe to T-bills or and others. So this is why you can see in bear market, even for now, you can see our savings vault, the APY is around 4%. But in other lending protocol like Evie or Morpho, the savings rate is much lower compared with us. So this is when we're thinking about the yield, we must know where is the revenue from for this protocol.
Thanks. Excellent input. So I think the next question is towards Mark and Gary. So Mark, Carbon DeFi is introducing professional-grade features like recurring orders and adjustable fees, giving users basically the power of an automated trading firm. And Gary, CICADA is bringing professional-grade assets, RWAs on-chain, ensuring yield comes from verifiable sources. And it seems both of you are raising the standard, the bar of what asset management means in DeFi, and moving away from simple deposit and hope model to a professional era. Can you tell me about how do you protocols help educate or empower users to manage their wealth with more sophistication, whether that's through better infrastructure or better asset selection?
Yeah, so there's a couple of things worth unpacking there. In your question, you said the deposit and hope mentality. And that actually resonates with me a lot. So the paradigm that I think emerged from DeFi summer was that there was a lot of excitement, a lot of new users entering the market who didn't really understand anything that they were doing. And what that created was an incentive for protocol designers and cryptocurrency businesses to provide really no explanation as to what the financial service is that the user is interacting with or the financial instrument that they're buying. And especially in decentralized exchanges, this idea of staking tokens or providing liquidity for fees, I think has been a really hard to shake lie, right, in the industry. I'm still of the opinion, and I've provided, I think, fairly robust arguments against the idea of fees and exchanges at all. And that this idea of like a fee being correlated to the financial performance of an AMM or any decentralized exchange is just fiction. But it does serve a marketing purpose, because the message of telling a user, put your tokens here and earn fees, is very simple. Whereas if you're telling a user, buy this short gamma option, that's much more confusing, and they don't really understand what that financial service is or that financial instrument is. So I think that doing away with the old vernacular, right, and not using words like stake or deposit, but really making sure that you provide like actual like self-exposition, right, in the UI that says, look, these are the decisions that you're making, and that this will be the financial outcome if the thing that you're hoping happens. And not using things like APY. Like, I think that APY or even APR is one of the most misused financial indicators anywhere in DeFi. You can go to any exchange anywhere and find, this token pair is yielding 120-something APY, even if that pool has actually not made a profit ever in its life. So this kind of deliberate miscommunication, I consider marketing hubris. And I think the more we gravitate away from the marketing terminology that was invented to sell DeFi in 2020, the more honest we become with the financial, services that are potentially being offered for the first time on blockchains, the more that we're going to attract a demographic that actually understands what those things are and how to use them. And I would much rather that kind of individual, right, the person who is of a certain intellectual level, right, who has the IQ to understand what these services are and these instruments are, and knows exactly what they want to do when they use them, and have the parameterization of the protocol expressed naturally in the way that they've been taught to interact with financial markets. I think that is much more compelling, that the educated user is the demographic that you're going for, rather than trying to bring in, uneducated people and try and teach them about finance. I think that that's the naive, dangerous approach that more DeFi protocols should probably be moving away from.
Thank you, Mark. For asset management, the education is very difficult. I mean, I spent at least 6 years to transfer myself from a traditional investor to a Web3 investor, because many of the ways is opposite. You have to think about liquidity first, but not value first. And in traditional finance, it's value first, and then finally, 5 years later, maybe 10 years later, think about liquidity and exchange. So the first of all, I think the very difficult thing is education, market education. It's very hard to merge the two market, Web3 DeFi native players, and also the traditional rational investor. So this is one of the biggest things. Once upon a time, I went to Vietnam, and I visited a very professional investor over there. They say that there are a lot of university students who want to play crypto. Why is that? Because crypto is neither the stock market nor the gambling. It's between something in the middle. So it's a new market, and you have to educate both of the customs and both of the education over there. So, and from the other side, people usually have got a imagination or even illusions, including myself. Once you want to invest some of the assets, they have got illusions. They want a very high return, very low risk, image that's 30% of APY. For example, like today, today's lunch, I've got a lunch together with some professional investors, and they say that, oh, I've got a strategy over there. It's a 100% APY. I say, that's impossible, and it's not sustainable. And you can go to the Wall Street, and the best asset is a 20% with the Sharpe ratio 3.5. This is one of the best class. If you say that it's 100%, and I will say that it's 100% is a scammer and a Ponzi game. So the thing is that how to put people back from illusion, how to give them rational thinking, and at the same time let them feel what is the real DeFi with the high liquidity. And then sometimes I talk to a traditional investor, very professional, say that Web3 is different than high liquidity. He said, oh, pretty good. I will do the T+0 thing every day. Why should you do that? It will bring squeeze. So high liquidity doesn't mean that you can withdraw, redeem every day, but it's a high liquidity, much better than traditional investment. So you have to get rid of this kind of illusion out of from their imagination. So there's a lot of different things that you have to do in community, your LP, your investor, and it's very hard to persuade them and say that, oh, this is a new kind of generation of asset, and still at the same time it's not scammer things. So this is what we're doing now, and I think it's a new asset class, and I think it should take time, several years, for many people to accept that this is a new asset class.
I want to follow up on something you said there, which was, people will come to you with their new DeFi product. Be look, it's got 120% APY.
Yeah.
And you're like, no, it doesn't. That's impossible. But what's interesting is that the blockchain industry, the DeFi industry, spent so much time and resources trying to convince people that that was normal, right? You remember 2019, 2020, right? And so the embedded, right, the deeply entrenched blockchain community that we have now will not settle for a 20% APY. And I'm not saying that we should try and strive for 100% APY, because that's never going to happen. But it means that there's this entire generation of crypto users that are now so disenfranchised, so disappointed with what reality actually is, that we now need to sort of turn our attention to either the people that always rejected those kinds of returns, and you see that they're coming to the table more and more now, or the people that were 16 or 18 years old in 2020 are now approaching crypto and sort of seeing it for the first time. But the people, like that well of people that was here and using Ethereum and, BSC and things back in 2020, 2021, I'd say that well is now poisoned forever, right? You're never going to be able to re-reach those people because they were there when 1,000% APY on SushiSwap during the vampire attack was kind of low.
Totally. A bunch of people come out from the casino and they ruin the market.
Yeah.
Okay, it's very interesting that you guys both mentioned like educating the users, and it's kind of somewhat sarcastic about the users' mentality going back and forth. But I guess when it comes to like marketing for a broader market or the whole industry, you just have to do certain things at certain times. So it's just the process. Now let's talk about the capital efficiency and infrastructure. This question, Spark is positioning itself as a liquidity layer, routing liquidity towards most needed across DeFi and CeFi. And Mark, Carbon focus on execution efficiency to protect users from MEV and prevent their strategies from being reversed by market noise. And for the industry to scale, yield isn't just about the APY number. It's about how efficiently capital is used. Can you talk a little bit about how does your infrastructure ensure that users get the most out of their capital?
Yeah, sure. So just as I disagree with the word fees that's used almost everywhere in DeFi, I also think that capital efficiency should have heavy air quotes around it, right? Capital efficiency in general has had a very rigid definition for many decades as being essentially the amount of money that you spend on R&D versus the amount of productivity or profit that brings. It was first bastardized by Uniswap, I think, when they started introducing their version of amplified liquidity, which was called concentrated liquidity, back in 2021. And the way that they use it is to basically compare how much volume a DEX can support versus the standard constant product model. And that is largely how it was adopted across the industry after that. But this is a very bad definition, especially because for liquidity providers, being more capital efficient using those heavy air quotes is actually meaning that you're putting more of your inventory at risk for a lower volatility profile compared to someone who is using constant product. So that efficiency claim is really from the perspective of people taking the market, not the people making it. So as a liquidity provider, you're generally trying to be as uncapital efficient as possible, because it means that you can wait for lower prices to buy assets from the market, even in a passive way, and wait for higher prices to sell them back to the market. So if you are providing, let's say, liquidity to a concentrated liquidity market, the capital efficiency there is really at your expense. And the reasoning for that, the justification for that, is that being able to process larger amounts of volume means that you can charge a smaller spread. And if you cross that spread many, many times, then your profitability, should go up. But this is only true if the market remains sideways. As soon as you get a market dump, then the person who provided liquidity to a much less capital efficient system has lost a lot less money, a lot less value than the person who provided liquidity to a more capital efficient one. So this way of categorizing DeFi products as being capital efficient is, again, more marketing hubris, right? It's not something that really exists in financial markets and never has. It's really been about the cost of running a business. And we shouldn't conflate those two things, right? Investing in financial instruments is neither efficient nor inefficient, right? The result, from someone's perspective, you can make the claim that it's more efficient for them if someone does something. But remember, it's adversarial. Most of this is still zero sum. So what is efficient from someone's perspective might be very inefficient from another person's perspective. But what I will say is that if you look at, for example, the original trading algorithm, so like the Bancor V1 constant product stuff in any number of dimensions, if you were of the mind that you're happy to provide a certain amount of capital to be taken from you through a certain price interval, then sure. The requirement that you have to provide more capital than the capital that you are even offering to the market through that range is kind of inefficient. And so the advent of amplified or concentrated liquidity, where you can actually just specify this exact price range you want to trade within, rather than having to contribute money to a pool and support all prices from 0 to infinity, I'd say is a step up. But let's just not conflate the idea of capital efficiency in that context with profitability or APY or anything else. The more efficient you are, usually the more at risk you are. It's leverage like anything else.
Maybe I think I can talk about the capital efficiency and also yield from Spark and also from the US Treasury two paths. For Spark or for yield, I think when talking about the yield, we should talk about the risk-adjusted yield, not only the yield. For example, if you have only like a $100, maybe you don't care, you put your money into like a high yield, maybe 100% of the yield. But if you have like a 10 million or even 1 billion, you should concern about the risk-adjusted yield. So if you are an investor or you are a capital allocator, you should know like which kind of bot or which kind of protocol should you allocate your liquidity. For Spark and the MakerDAO Sky, like we only support like Bitcoin and wrapped Bitcoin and also LST Ethereum as a collateral in our blue chip Spark lend. This is why like we call us like low risk DeFi. So anyone here, like you can just check the ticker of the low risk DeFi. I think in the future it is a word of the low risk DeFi, not the high risk DeFi. And also we come back to the capital efficiency. I think the total blockchain is like capital efficiency tool for the U.S. Treasury in the next few years, because like previously when the U.S. government want to sell their U.S. Treasuries, they must come to Hong Kong or come to like a mainland of China or come to anywhere to talk with the government. But I think for now they just use the TRON as a distribution channel to distribute the USDT or USDC like a treasury-backed stable coins, use the blockchain, and then no need to care about the government. Directly distribute the US Treasury or stable coins to anyone here, individual. So I think this is the capital efficiency. This is I think what is blockchain for now. So I think in the future, if you want to invest something like in blockchain, you can just see which kind of the protocols or which kind of the chain can be the distribution channel for the US Treasuries, maybe in the next 4 years. Yeah.
Yeah, I mean, I think to add on to that too, it's also really important to ensure that when dealing with USDT on TRON and things of that matter, we're still abiding by proper regulations across the various governments to ensure that there's no money laundering that occurs, drug trafficking, or any sort of financing terrorism that occurs on chain as well. And the TRON network has done a big job of working with global law enforcement to reducing as much illicit activity that may occur on chain. But to my fellow panelists' point, I really like to look at TRON again as an infrastructure for payments. I know we've talked a lot about capital efficiency and yield and things of that matter, but in terms of the reliability of the TRON network itself and its infrastructure, we've had no downtime since our inception. We've settled $25 trillion in payment flow, a lot of it being USDT on TRON as well as other types of stablecoins. And these are people across the entire globe moving money for cross-border payments, moving money for remittances, and also big companies dealing with B2B payments being able to now do import and export. There was a study that was done in sub-Saharan Africa looking at 11 countries and dealing with the type of amount of fees that they had to pay when doing those imports and exports across those 11 neighboring nations. And they found that they had to pay around 10 to 12%, so about 11% in fees on those transactions and on those activities. That amounted to about $10 billion. Now, $10 billion in any market is a lot, but in the global south, especially in Africa, that's magnitudes more powerful of money that can help those economies scale accordingly, that can help them now then gain access to adequate financial services, compliantly speaking, so that they can scale properly. And I think it's really important to take a step back and look at the ethos of why blockchain technology was created. There's different perspectives of it. One perspective I like to look at it is we're providing financial infrastructure and architecture to the rest of the world, as it's not something that should just be given to a select few of people. I think it's genuinely something that should be allowed to and applied to everybody. And I'm proud to say that TRON has been doing a great job of that, and looking forward to seeing more people build more amazing things as well.
Yeah, that's actually my next question. But I wanted to take a look at the expanding this whole ecosystem, because TRON is bridging DeFi to the real economy through payments. And congratulations on your recent regulatory achievements in Abu Dhabi. Right? And Gary, your work with RWAs is bridging on-chain DeFi with off-chain real-world value. I mean, we often talk about mass adoption ever since so many years ago. But do you believe like the next wave of growth comes from these bridges to the real world? And like, I know like we have different products and we have different like stances, or but how do we like bridge this next $1 trillion on-chain?
Yeah, I mean that the scalable is actually very important. I mean that, for example, like Coinbase give everyone a good report, and this report actually based on 4 different kind of assets. One is a commodity, one is a T-bill and treasury. The third one is a loan file, which is based on the collateral loan, and the other one is a private credit, which is a private debt, private loans, and private equities. And so actually, the scalable and mass adoption to trillion, I think is too big a number. We can put an eye on to 100 billion. It's very important. For example, like Maple. Maple is, what does Maple do? Actually, this is very important. Ondo is doing the asset of a T-bill, which is a AA loan market in the US. Maple is doing the collateral loan and a corporate loan market, and so does Figure, because Maple use the lending protocol way, Figure use the mapping way. So they are focusing on single A collateral loan market compared with the traditional loan market. So they are actually very focused on what they are doing. So this is very important because single A loan market actually is $100 billion market. And then if you enlarge that, that can be a trillion market sometimes. Yeah. So this is a very big market for loan market because everyone knows that the loan market in the US is bigger than the currency market even. So I'll go back to the quantified market. Quantified market actually in crypto is a very niche market. Ecena actually has touched the number of $14 billion for TVL and AUM. But actually, this is a very big number. So many people ask me about the quantify, whether you can have the quantify very prosperous in 2026. No, you cannot. Because quantify is very limited, and quantify in crypto actually is a market lower than $100 billion. But later on, in 2 years later, for a stock market, no matter SEC or other kind of central platform agree on that 24/7 hours, and then you can use the tokenized version of stock market and a commodity, then there will be more alpha coming into the market. And so at that time, we will have more quantify. So this strategy, niche market, will be bigger that way. So this is why loan market and quantified market, and also the PayFi. Actually, to be honest, many of the payment actually in the gray area are not counted inside the Coinbase report. I can see that in Africa, in South America, in the Southeast Asia, in South Asia, many of these payment actually definitely is PayFi are not included. So all of this asset actually can be put into actually more positive and more professional in this year or the next. So supply chain fi, payment, PayFi, and currency asset actually will be put into many different asset class. And for this asset class will be definitely bigger than $1 trillion. And you can read the Coinbase report that already, for now, USDT and many of the stable coins only have got in total is $300 billion stable coins flow everywhere in the world. But actually, that supply of $47.6 trillion the transactions means that this is quite a big number. And this number will definitely have got an exponential model in the next few years. So $1 trillion is okay, but we have to focus on the right way, which I think it's not quantified, but loan market is okay, but supply chain fi and PayFi market.
Can I just jump into recognizing the Abu Dhabi victory we had with Vara, recognizing USDT on TRON? But to go to his point as well, I think it's really important to look at the problems that are currently found in traditional loan origination. It's extremely slow, it can be costly, and it's very, very cumbersome and very paper heavy. If you can find a way to be able to make it faster, make it more efficient, programmable, and less paper heavy, you've now been able to open up a credit market to potentially millions, if not billions, of people across the world, and are now able to originate more credit in economies to actually scale more appropriately. That solution is blockchain technology, or so we say so. And I really think that's the direction that we need to start to continue to move in. That's where RWAs come into it. And then into the PayFi front as well. That's just the concept of, again, moving money from one place to another. To throw some other really big numbers around, the global annual payment flow that occurred in 2025 of all types of payments that happened in the globe was $2 quadrillion. Okay, that's $2,000 trillion. This is the amount of money that went from one place to another and settled across the entire globe. The amount of that happened and was filtered accordingly on crypto or using blockchain rails was about $1 trillion. There's plenty of other assets that were traded, obviously growing that number out. But that should show how big the PayFi industry can be disrupted using blockchain technology. And the amount of tokenized assets that are available are also pretty, I don't want to say negligible, but they're very, very limited compared to where we can go in terms of credit markets, in terms of VC markets, in terms of other types of assets that we can make tokenized in an appropriate manner. So those are just some numbers that I wanted to throw out there because I do think they're worthy of kind of noting.
Do you think that I mean, you said that there's a paper-heavy sort of, burden, right, on traditional rails. How long do you think that burden won't exist in blockchain. Because I'm of two minds about these things. I think that on traditional rails, that burden could be ameliorated by itself. Like, there's nothing special about a blockchain that takes away, the policy that has been, put on top of these products, right? And to assume that Bitcoin has a defensible moat simply because of that, I think is not acknowledging that there could be just a grand deregulation across the world that's like, fine, all of the stuff that we did to make traditional finance difficult, we're just going to undo all that, and now the traditional rails are going to compete with blockchain. Or the reverse, right? That as regulation creeps into blockchain, it could be that it becomes as paper heavy as the alternative. At some sense, you are really, like, the interesting thing, I think, in DeFi and CeFi right now is that it reminds me a lot of, like, the Windows versus Mac OS X operating systems, right? Where it's not like one is implicitly or intrinsically better than the other, but they do have different features and, do things different ways. But whatever happens in one operating system, you could easily put into the other, into the other one. I'm just wondering, like, if the efficiency that you're speaking about with respect to the lack of, like, regulatory intervention being the thing that keeps it moving, do you foresee that that's going to continue into the future, or are you getting the same feeling that I am, that as regulation creeps in, it slows everything down, and eventually these things are going to be neck and neck?
I don't think regulatory intervention is going to effectively, deter growth. Maybe there will be a pain point within it, but I think it's necessary to ensure that there's no counterterrorism that's occurring, or you want counterterrorism to go against the terrorism, right? You want to make sure that there's no drug trafficking or any sort of illicit activity that occurs on chain. Just because something's decentralized doesn't mean that people can take advantage of that system and take advantage of other people. I think that's extremely important to note. But to your point, I do think as regulation starts to peer in, as it already has, once we get over those hurdles and those pain points, and in some eyes they might not even be viewed as pain points, I still think the user experience, the seamlessness of actually gaining access to that infrastructure to move money from one place to another will still be as good as it was beforehand. So especially from a payments point of view, it's really just the user experience that needs to continue to be improved. And I think regulators are going to help bring that to more mass adoption, especially when you're looking at like a full stablecoin sandwich model. Some people, they may never be able to grasp the concept of using stablecoins. They may always want to do fiat pay in and fiat pay out, but the actual institutions that are taking time to do the KYC, do the KYB, go through all the regulatory matters, are using blockchain systems internally to be able to move funds on a faster basis and pre-fund accounts from one quarter to another, improving the entire experience. So hopefully that answers your question.
Okay, thanks for sharing that. So in the questions before, we've gone deep into your products, your mechanism, how you, and I think the audience now have a very clear understanding of what you guys do. And now we want to zoom out. We've designed this next section around the most heated topics currently being debated in the industry. But unfortunately, because we're running a bit late, we'll have to unfortunately cut the question into just one question. But for the next one question, the floor is open. Let's make this like a free-flowing conversation style. Feel free to jump in, respond to each other's inputs, and let's get a real discussion going. So the question is like, is there a fundamental trade-off between yield, liquidity, and safety in DeFi and CeFi or CeDeFi? And which dimensions do users or sometimes even protocols often misjudge or ignore?
Yeah, okay, so just to repeat that, is there a fundamental trade-off between yield, liquidity, and safety in DeFi and CeDeFi? Which dimension do users or even protocols often misjudge? And I think it's a really nuanced question. I don't think that there is a fundamental trade-off, right? That would suggest that, in order to attain some sort of goal, you need to give up something to get there. I think that that is demonstrably not true. However, I would say that these things are correlated. For for protocols that are, or DeFi products that are advertising impossible yields, right? As we've been discussing here on stage on several occasions. Oftentimes, those yields are deliberately and maliciously manipulated and are designed to trick users into using their protocol. And I do think that in that sense, you're kind of trading off safety for yield, but in that case, the yield isn't even real, right? I think that this is just normal sort of scam tactics. I will say that, with respect to what I was saying before about capital efficiency being just sort of a masked term for leverage, there is, you can make the case that leverage does attract a higher yield. Not on average, mind you. Remember, there was a Nobel Prize awarded for, I think, Miller and Modigliani, who proved that leverage systems are no more efficient than unleveraged systems, at least when it comes to structuring corporate finance. But on occasion, you will win big if you're levered up. It just means that the chances of you losing big when you're levered up are also sufficient to displace the advantage that you think that you get. But if you have an extremely high confidence level, right? For example, we see that the Bitcoin price has been tumbling down dramatically quickly and then made a quick bounce. At this point in time, if you have an edge, right, and you know beyond any shred of a doubt what's happening tomorrow, then yes, you can leverage your position and make a bigger profit than what you would have been able to without trading on margin, for example. But if you're even a little bit uncertain, right, or if there's any chance at all that the market might move against you, then yes, you are trading safety for the possibility of a higher yield. And as long as you remember this example, everything in DeFi and CeFi eventually reduces to those axioms, right? Do you know the future? Yes or no? Or how confident are you about what's going to happen in the future? If you're very, very confident, then you can trade safety, meaning the confidence that you have in yourself and your predictions, for a higher return. But if your confidence is low, then you probably shouldn't lever up, and you can trade a smaller yield for a higher level of protection. It's similar to, if you're trading on a roulette table and you just bet on every single number, right? Then your returns are going to be low because you lose almost every single bet except one. Whereas if you bet on one number, you're going to lose a lot more frequently, but at the possibility of a higher return. That is it. That is all of finance, right? How confident are you? How certain is the outcome? And how much are you willing to bet that you're not going to be wrong? It's true of every protocol, every financial instrument you'll ever buy. I think that's the best advice I can give you.
Okay, I think the yield for Spark and Sky is like off-chain yield and also on-chain yield. And also for CeDeFi is also CeFi yield and also DeFi yield from borrowing and also from the funding rate in the future. And also, but I think the best yield assets for in crypto is like the assets without the yield. It's like a Bitcoin, and also in the future I think it's on-chain gold. Yeah.
Yeah, I'll keep it short as well. I think all of them can coexist in terms of those variables. Assuming that you can only do a couple of them with some of them being traded off. I think that could be seen as an excuse to just say that you're going to have 1,000% yield, when in reality, if you just take more time, do more honest marketing, and actually build the proper products that are needed to be built, you can achieve all of those forms. And with the TRON network, again, we try to stay reliable. We want to ensure that security is there, and I think that's also a very important thing when navigating on-chain finance, making sure that not just the product is actually proper, but you're not subject to any sort of security risks.
So from my view, give you the conclusion. For long term, actually, long-term view, it will be very, very quickly. I mean, that will happen in less than 2 years. But from a short view, for this year, I think it's a pretty struggle, and we'll have many regulation things to face, and so there will be many exchanges. So we will face very deep changes of the concept of the regulation thing of all of this, and then we will mix this together and try to change the CeFi view to the DeFi view. So
This is it.
Okay, does anyone want to add on to that, or because this is the last question?
Oh, okay. Maybe touch up a little bit. I have a question for Dr. Mark Richardson, really diving into the economist that you mentioned, the Nobel Prize that they won. I'm curious, what type of approach do you take? Do you take more of the I'm always right, the quantitative confidence approach, or do you take more of the levered safety approach? And then how do you apply that to the broader market? Because from how you mentioned it, what if there are news that are being circulated that are pushing people to think a certain way, to be overly confident? And do we see a lot of that in crypto and Web3? I remember, I think around 2020, there were a lot of algorithmic traders that believed this certain thing through their algorithms or their quantitative trading, and they were wrong, and it brought the oil price down to negative numbers. So I'm curious how you look at that as a whole.
Yeah, it's a fair question. I mean, I wouldn't categorize myself as a trader at all, really, or even an investor. I'm a worker. I do the smart contract, audits and protocol design elements of things. That's not to say I don't use my own protocols, but I think that when I do it, I do it in the same way that someone might bet on a sports team that they really like, or something like that. And so, if there's a soccer game or a football game or a tennis match, and I'm like, I really want this person to win, right? That's it's my want that does it, and I'm not doing it with huge amounts of personal value. But what I will say is that generally, it's even in sports events, the people that take your bet and the people who bet against you often know the outcome of the match before you do. Right? And really, that's the question that you should be asking yourself in financial markets as well. Like, if Wintermute has taken a position and you're going to bet against them, you have to ask, like, how confident am I that Wintermute isn't going to precipitate the outcome that they're looking to take, right? One of the conversations I had with someone recently, especially about crypto markets, but now apparently in gold and silver as well, is that the derivatives markets are kind of now dictating what happens to the primary markets or the secondary markets, in the sense that if I'm the bookie and I can see the futures markets and I'm taking all of these bets and I have enough liquidity on my balance sheet, enough inventory on my balance sheet to move the underlying market, and I am, let's say, I'm going to be on the hook for $2 billion in payouts if the price moves up, but only $1 million in payouts when the price comes down, and I have enough inventory to make the price do whatever I want, right? Then there's no way that I'm going to place a bet with that bookie, right? Or if I am, even if I don't think that outcome makes sense, I'm going to do the thing that they should do because it's going to cause them to pay out the least amount, if that makes sense. And if I don't have insight into what that market looks like, I'm not participating in that market.
Okay, I guess that's the end of our panel.